what is the ideal gold to silver ratio to have in their portfolio?
All investors want one size fits all answers, and there aren't any. It depends on the investor. Traditionally, gold bullion has been it's been a form of insurance, Shay. You have preserved your purchasing power in circumstances where the purchasing power in other savings and investment classes gets degraded. So you would buy gold if you believed that the purchasing power of the Australian dollar was going to decline and the value of your savings products, your super, your bank deposits, your bonds was going to decrease. Silver has traditionally been something different. Silver has been more of an investment or a speculation than an insurance product. And if you observe the last two precious metals bull markets that I've lived through, 1970 to 1981, 2000 to 2011, what you will note, among other things, is that those bull markets are led by gold because the fear buyers first. But leadership changes in the middle of those bull markets when the momentum established by gold puts the value of the narrative firmly in the generalist mind. Then silver starts to move. It moves both because its lower unit value allows poorer participants, as an example, the Indian peasantry, poor people in China, to participate where they couldn't afford to buy a meaningful amount of gold. They can't afford to buy a meaningful amount of silver. But it also happens because silver is traditionally more volatile. And people who are buying for one of the two primary investment motivations, the two are, of course, greed and fear. People who are buying from a greed point of view love the upside volatility in the silver market that occurs in the second half of precious metals bull markets. So the answer really depends on who you are. And I must admit, I'm of mixed minds. I believe that the set of circumstances that we see in front of us in the world today should cause anybody who is competent in arithmetic to be concerned about the purchasing power of their savings denominated in fiat currencies, be it the Australian dollar or the US dollar. So I'm attracted to gold. I'm attracted to gold stocks because, ironically, nobody likes them, and I always feel comfortable when I'm alone. But I like them too because, in the way that I value them, which is the net present value of future cash flows at today's commodity prices. That is to say, net present value relative to enterprise value, the market capitalization plus debt minus cash. These companies at current commodity prices, their cash flows are the cheapest that they've been in my career. So I think that the commodity is going to go up, and I think the commodity prices, producers are cheap. This is a wonderful circumstance for me. I find myself actually in the position where I own a reasonable amount of gold, a reasonable amount of gold stocks, that I'm hoping the price goes lower because I'd like to buy more. And if there's an asset that you want, you'd like to see it cheaper as opposed to more expensive. That gets me an awful lot of hate in the comments on shows like yours. But I've always felt that the idea that something that I wanted to buy more of was becoming cheaper was a good thing. I have the courage of my convictions. Moving on to silver, Shay, I'm at the point in my career where I don't actually need to speculate, but I can't help myself. What I have seen is that the most volatile asset class in the natural resources space, with the possible exception of junior uraniums, but the most consistently volatile are silver equities, because there isn't enough market capitalization in the legitimate silver equity space to handle the capital that comes into them during precious metals bull markets. I've had numerous experiences with this in my career. Silver Standard from 72 cents to $45. Pan American, 50 cents to $40. Going back before I was cognizant of it in my first bull market, Coeur d'Alene from 10 cents to $65. The upside that you see in the silver equities when the silver market catches on fire is really, truly odd. So despite the fact that I don't need to speculate, given that this may be the last precious metal super cycle of my career, I just can't not participate. in the silver equities. And the fact that they're dead, the fact that not only do they bore people, but that people hate them, is particularly attractive. You may remember earlier in the year the so-called silver squeeze.
Yes.
And I must say, I was surprised by the strength of it. I was surprised that we didn't just run out of retail product, at ABC or places like that. For a while, all those young folks on Twitter actually bought so much silver that even Sprott had trouble getting institutional quantities of silver. We actually did have a legitimate, albeit short-term, silver squeeze. But the real squeeze, Shay, comes very differently. It comes from reversion to mean. It comes from arithmetic, not narrative. In the US, I don't know the Australian numbers, but in the US, precious metals and precious metals equities comprise 0.5% of total savings and investment assets in the country. The 3-decade mean is 1.5%. And I believe that a combination of quantitative easing, which, as you know, I call counterfeiting, debt and deficits, and negative real interest rates will, over the next 5 years, cause demand for precious metals and precious metals assets to at least return to mean. If they return to mean, it means that demand will triple.